All right, let's start. Annie, if you want to pull off the slide for a second so that we can introduce our fantastic guests. Today, we are with Stephen McClurg, my co-founder and the CIO here at Valkyrie, and Josh, our head of research. This is going to be a very interesting Bitcoin answers today. It's a little bit more robust than we usually do. We're going to deep dive into the global issues, both macro and micro, what we're looking at on a global scale from a traditional finance perspective. Stephen's going to share his thoughts, and Josh is going to get into the weeds, especially answering all the big questions of what's been going on recently. But let me pause. And Stephen, it's amazing to have you here. Can you also tell everybody, because there's some new faces that I can see from the attendee list, a little bit about your background too?
Yeah, absolutely. Well, I spent quite a bit of time in traditional finance, mostly on the institutional side of the business, working with large insurance companies and pension companies, mainly managing portfolios, managing risk, hedge funds, the whole group, before we got into digital assets. So my background educationally is mostly economics, both behavioral economics and macroeconomics. And we try to apply a macroeconomic overviee to everything that we do at Valkyrie when we're managing risk and managing markets. So I actually love bear markets. This is always my favorite time of cycles. So we've been preparing for this for a long time now, and now we're working through it.
Unfortunately, preparing for this for a long time now. I wish that we weren't so pessimistic, but it is great that we have had defensive strategies thanks to you. And Josh, thanks for joining and for your analysis to come. Can you also tell everybody a little bit about your background?
Sure, yeah. So I started in digital assets in 2013, almost going on a decade now. Both trading full-time, research full-time for the better part of 5 years, prop trading as well. So I have a deep background in that sense, and my lack of knowledge is definitely TradFi. So that's how we make a good yin and yang. Stephen's like the best of both of us, and then we have this mix of TradFi and digital.
That's perfect. Well, since we have the mix, let's go back to the slides and let's jump right in. Perfect. Well, I'm going to turn it to you first, Stephen. Can you tell us a little bit what you're thinking? This chart is obviously Bitcoin prices relative to the money supply, but that's definitely an intro to greater economic issues. So what are you seeing here? What are you thinking?
Yeah, well, I'm not going to talk about how these charts are related, so to speak, but definitely going to talk to what's going on in each one of these charts. So really, what Bitcoin is, it came out of the last financial crisis, and when we came out of the last financial crisis, Mr. Bernanke was printing helicopter money, and we essentially were creating a large monetary supply to offset the low velocity of money. And the velocity of money went down quite a bit because the credit markets collapsed. And credit was what was really fueling at the time the higher velocity of money, and inflation was starting to seep in at that time. And when more money began to be printed, and it happened for about 12 years, everybody expected for inflation to really set in, but it really didn't until 2 years ago. And the thing that prevented inflation from setting in before was really wage growth. So despite the fact that more money was being injected to the system, and in your economics 101 books, you typically learn that, if there's more money, there's going to be more inflation. But if you're a Keynesian, you'll know that that's also due to long lags of time, that things don't just happen instantly. They have to work its way through the system. And in this case, it took about 10 years for inflation to really work its way through the system and to get to an event where we actually had higher wage growth. So once higher wage growth set in, and then we began to have supply chain issues, and employment issues, people not working, that really set off the bomb that was, expected to happen at any moment. Usually events happen with a catalyst, and the hardest thing to time in markets is when that catalyst is going to hit. Well, the catalyst for the markets was COVID. And even pre-COVID, we were expecting wage growth to set in. We were expecting inflation to come, and we were expecting the end of the latest cycle, which ends in recession. And we did have a quick dip in the markets, but more money was printed, and very accommodative monetary policy offset that. And it lasted for a little bit of time, but with increased government spending, increased wage growth, supply chain issues, inflation really began to set in about 1.5 years ago. A year ago, it was believed to be transitory, which we knew better. We were looking at things like oil prices, wheat prices a year ago, and these aren't items that are going to simply, go away. And it wasn't simply due to supply chain. We were really looking at wage growth, and that was really the important factor that had been missing all along. And now that we have it, and we expect to see continued wage growth, we expect inflation to come in even stronger. Now, going back to Bitcoin and going back to the monetary supply, Bitcoin has a fixed supply and anti-inflationary measures in place. So as a currency, it's really built to offset inflation. And people say, well, has Bitcoin really been an offset to inflation in the last year? And the question is no, right? It has been a good inflationary hedge over the last 10 years as you zoom out, but any asset trades the way that people trade it. So Bitcoin, as it entered a lot of people's portfolios in the last 2 years, even in the institutional world, began to act more like a risk asset. Even though in the long term, we still believe that it will be an anti-inflationary asset and a type of money. But in the short run, it's turned into a risk asset. And as a risk asset, when we have news that comes out that's negative or positive, right? It's also gone up on positive news. If that news comes out outside of trading hours in the market, then people that manage portfolios are going to trade the asset that is the most liquid and is available to trade. So if now that Bitcoin trades 24/7, and if that and crypto is available to trade on a weekend when news comes out, then it will be traded first, right? So you always trade, the most risky, the most liquid first, and then you work your way down the stack. And as you work your way down the stack, this is why crypto has seen the most volatility over the last 6 months. Equities has also seen quite a bit of volatility because it is liquid and it has traded off as well. Many tech stocks are down 70, 80%. NASDAQ's down 30, the S&P's down over 20. And by the way, we expect those to go even further down. Even bonds have had quite a bit of volatility, but the reason why bonds have been volatile isn't just because of the Fed unwinding the balance sheet. Bonds have been volatile because of the lack of liquidity in the bond market. So the spreads between prices have been wide, and anytime you have wide spreads and lack of liquidity, you're going to see trades bounce in between prices, and that's what's created that volatility. What do we see in the future? We believe that the Fed is going to continue to tighten. We believe that this is just the beginning. We were expecting the print that we saw today. We were expecting over 9%. We've been talking about high inflation and lower markets since October, which is really when the top was. And we've been preparing ourselves for this, both in our portfolios and as a firm. And we've been writing quite a bit about it. And now we're looking at, when's it going to turn around? We don't think it's going to turn around until inflation is beat. And there's really two factors here that the Fed is looking at. Number one The Fed is looking at inflation itself, and they don't care if they completely tank the markets to get inflation under control. They caused inflation. Now they have to fight it. And until we get an inflation print less than 3%, we believe that the Fed probably will not pivot. The second factor to look at is unemployment. After the Great Recession, the Fed had a dual mandate that was added to its mandate. And the first mandate obviously is low, steady inflation of between 2 and 3%. The second mandate became unemployment. So 5% unemployment is considered actually full employment. And with unemployment in the 3% range, the Fed doesn't have to worry about the unemployment rate going up right now. If we see the unemployment rate going above 5%, hitting 6, 7%, that might be another trigger for the Fed to move directions. But until one of those two things happen, until inflation goes down or unemployment starts to get out of control, the Fed is going to continue to tighten. They're going to continue to raise rates. They're going to continue to unwind the balance sheet, and they're going to continue to use rhetoric to let markets know that they're going to continue to tighten to fight inflation. And this will cause markets, as liquidity comes out of the market, markets will continue to go down. We think that we'll see another 20 to 30% down in equities, another 30 to 50% down in crypto. And even the bond market, which the 2s and 10s spread right now is now negative 15 basis points. So that's really signaling a recession from a yield curve perspective. So all of those factors put in, it's going to be a really rough summer, and it's probably going to be rough all the way up until at least November. But like I said, until we see the Fed pivot and liquidity start going back into the markets, we do expect the markets to continue to go down.
Thank you, Stephen. And before I turn it to Josh, one more question based on what you're saying. Should we expect continued coupling with crypto and TradFi, or when should we expect decoupling?
Yeah, so one of the interesting things with crypto and Bitcoin and the rest of crypto is going to be a little bit different. Bitcoin is really held up versus the rest of the crypto markets, as well as a lot of tech stocks, frankly. But it was the first to go down, and crypto markets were the first to go down as well. So we expect it to be the first to go down, but we also expect crypto to be the last to come up. But all that being said, we probably will see a bottom form in crypto, and the bottom to remain, or at least prices to remain at that bottom for a longer period of time than it will in equities and other financial assets. So the decoupling will likely happen around the time that the Fed changes course. We'll see it act like a risk asset for a little bit longer, and then slowly correlate back over to, for the rest of crypto, closer to tech stocks, and for Bitcoin, a little bit more of either a gold-like or a foreign currency-like a play, and that's in the future.
That makes sense, Stephen. Thanks. And Josh, switching to you, often we do talk about stablecoins as an alternative, CBDCs or stablecoins, and obviously talking about it quite a lot now, given all the issues and how it led to the collapse. But starting with this slide, I would love to just hear your thoughts on generally stablecoins as a timeline of how we got to where we are now.
Yeah, sure. So, stablecoins for a lot of people are kind of the boogeyman, especially Tether, which gets a ton of press, or has gotten a ton of press for anybody paying a little bit of attention, especially recently with the short interest on Tether building. But initially, stablecoins like Tether was created around 2015, and it acted as a fiat pair for exchanges that didn't have fiat on-ramps, so USD on-ramps. Back then, and even now to some degree, exchanges have trouble with fiat on-ramps in various countries. So it made sense at that time from a utility perspective that, okay, let's create this token, and let's allow exchanges to use it and users to freely transfer USD between exchanges without dealing with the legacy banking system. For instance, you could move Tether around extremely quickly, whereas trying to get an on-ramp to an exchange on a weekend or a holiday, that would be delayed, right? So this was one part of it. Another part of it was a potential hedge against volatility, which is what a lot of people have used it as historically. But before really 2020, stablecoins were a big part of the crypto conversation, digital asset conversation. They were certainly everywhere on the exchanges, but it's really in DeFi is where the stablecoin circulating supplies kind of took off. So USDC was created in 2018, along with GUSD. Those kind of came about because there were concerns regarding Tether's reserves and what Tether was doing with those reserves, which is a lot where this boogeyman baggage comes from historically, because Tether has done questionable things in the past. As they're not doing that as much anymore. They certainly cleaned up their act in a big way. They're more transparent with their reserves, but they aren't USDC transparent. They aren't USDC levels of acting with their reserves, let's say, and I'll get to that later in a second. But the second thing to know is not all stablecoins are created equally. As the years have gone on, there have been different types of stablecoins, at least attempted or tried to be created. The first category would be the fiat-backed stablecoins. That's the household names like Tether, USDC, GUSD, BUSD, Paxos. You can see as a slice of the total circulating supply, they certainly are a majority of the stablecoin circulating supply. Then we have others like DAI and MIM. Those are crypto-backed, so those are backed by collateral held on-chain versus off-chain reserves in a bank, for instance. And then the third category, which is where we get into trouble with Terra and UST, would be algorithmic. And those are kind of like a perpetual motion machine where there's this expectation that we can mint and burn 2 tokens and everything's going to be fine. And we can sort of control this in an open operations situation and things will be quote unquote stable. Historically, these have really had a lot of trouble maintaining that stability, Terra being the most obvious example. But even before Terra, it's not like this wasn't tried and really failed in a big way. Previously, it's just Terra was certainly the biggest of them.
And Josh, before you move into the next slide, I just have a question for you, Stephen. Based on this slide and specifically fiat-backed stablecoins, can fiat-backed stablecoins serve as good treasury management in a time like now?
Well, some can, some don't. They're not all created equal. And one of the things that we do is we try to look at counterparty risk and code risk and security risk as we're looking at stable coins, as we're looking at the platforms that they're on. And there's actually very few platforms and very few stable coins that we'll actually touch. So some are very good. I'll just use 2 examples, USDC and GUSD. Both have really strong custody controls in place. Both use third-party custodies to hold their assets that back the coin, and they both use third-party managers that are not, that are trusted managers. For instance, USDC utilizes BlackRock to manage a lot of their treasury and holds it at BNY. So looking through and seeing the transparency of both of these coins, they are trusted coins. Now, of course, second piece, like I said, is the platforms. Which platforms are you using them on? We've been fortunate enough to avoid the big platforms that have really blown up in the last 3 months because we have a strong due diligence process when we look at counterparties. And if there's not transparency or we can't understand what's going on in the background, then we don't touch it. I really equate this time very similar to trading mortgage-backed securities back in 2007, right? Everybody wanted to trade with Lehman Brothers and Bear Stearns because, well, they were the biggest players in mortgage-backed securities and asset-backed securities. And if those were your only 2 counterparties, you may have run into trouble over those couple of years. It's why you have to be really, really careful about who your counterparties are. Don't just go for the biggest. Don't just go for the ones with the best price or the biggest yield. or the ones that give you favors. You really have to do your due diligence on counterparties and manage the risk and diversify your counterparty risk as well, even if your counterparties are trusted.
One
That
other
makes
thing
sense.
I'll add is there's also a fourth version of stablecoin, which is a hybrid combination of some of these definitions. And for instance, MakerDAO is touching the real world now and going and putting treasury reserves in a bank. So that just got approved based on their governance not too long ago. So it's good to see crypto use things that we know work, which is, real world reserves. Those have worked for a long time. So we don't need to try to reinvent the wheel here, and try to create something like Terra that really has had no history kind of working out.
Well, quite the lead. Let's lead right back into Terra. And what happened, Josh?
Yeah, so to try to understand, right, how all these crypto lenders are in trouble and how there's all this contagion, it kind of all started and kicked off with Luna collapsing in early May. And like I said, it had this algorithmic sort of open market operation system where if UST prices started to fall, which they did, which they went below their dollar market rate. Peg to me is a terrible word. It's really a market rate. If someone's willing to sell it at 86 cents and the market's willing to buy that, then it is what it is, right? Now, Tether doesn't necessarily have an open market operation, neither does USDC. Tether and USDC's pegs are mainly based on faith in the redemption. So I'll talk about Tether's price in a second, but Tether's price still remains slightly below $1, whereas USDC's price is slightly above $1. But back to Luna and UST, what started to happen was the UST price started to drop below $1. This is data from Glassnodes, by the way. And what the system was meant to do, which worked beautifully, flawlessly, it was worked as intended, was to start to mint Luna and burn UST. Now, the problem here is if the UST value in aggregate, the UST market cap exceeds Luna market cap, then you sort of have this asset debt mismatch at that point, right? Because you have more debt than you can actually repay using Luna as your reserve. And now they had additional reserves. They had Bitcoin reserves that they also attempted to use to shore this up. And you can kind of see that first attempt around May 10th. There was some like celebrations going on at that time. We had staved the worst of it. But while all this is going on, you also have traders piling in on the short side on Luna, traders piling in on the short side on UST. And it's really a losing battle in this negative feedback loop, death spiral, however you want to think about it. And what ended up happening was it's not currently 12 cents, by the way, it's currently basically zero. But what ended up happening was as the UST supply was continued to be burned over time, the Luna supply increased from 343 million to 6.53 trillion. So I got this question from an RIA, like, how does 50 billion disappear? And this is how that happens. It really just got inflated away. Now, some entities and individuals escaped this ecosystem as this was happening. Some of them 80 cents on the dollar, 50 cents on the dollar, some of them 0 cents on the dollar, right? Which is 3AC's case. Allegedly, they got caught up in all this for hundreds of millions, but this is sort of how that happened. And really the market didn't, Luna kind of hit a top. We started to wobble a little bit, but in general, all this stuff sort of kicked off before Legacy or with Legacy, right? This wasn't like out of the question that prices were pulling back a little bit, certainly. So this is really a big part of what we're seeing now in the contagion side of things, because what we had was this piling into DeFi platforms, specifically Anchor, from lenders and individuals, where in this ecosystem, the question is, where does the yield come from, right? And the answer typically is, well, the borrower pays interest on a loan, right? And then the lender receives funds back with interest based on what they lent, based on supply and demand of the collateral at that time, right? So this system works and has worked in DeFi. You know, again, the protocols themselves work fantastically. It's what the centralized parties did with the collateral that was the real problem, right? We sort of put all our eggs in one basket, and you know, this is kind of a picture of what's been coming out over the past couple weeks. But what we sort of know has been happening or has happened before Anchor and Luna and Terra blew up was some of these lenders were either lending directly to Three Arrows or directly into Anchor. And obviously, you know, that now that that's effectively zero, all of a sudden, all these lenders aren't in a lot of trouble on what they were doing. At Three Arrows Capital, obviously, massive trouble with debts, and in bankruptcy, restructuring. Celsius Voyager in restructuring. Some of these on-chain lenders or venture capital firms in trouble. Genesis, Nexo, BlockFi, blockchain.com. I think for the most part, the conclusion currently is that they're okay. Genesis, sort of being the biggest among them, has come out and said they took a significant loss. But all of this sort of ties into everybody piling into this 20% yield product, which sounds too good to be true. And it turns out it was unsustainable. If anybody remembers BitConnect was offering a 10% yield, and that was a Ponzi that blew up. But this kind of gives you the picture of what's been happening over the past couple weeks, really. Sort of all of this coming to light, and Celsius saying, yeah, we don't have what we think we do, or we don't have assets to repay. Individuals trying to redeem. So as there's this effectively a bank run on some of these lenders, they just had to say, you know what, we need to shut down, withdraw capabilities here. So I guess I'll pause there for any questions or specifics.
Thank you, Josh. This definitely lays it out, and I think it's quite terrifying, to be honest. So Stephen, you know, I'm going to turn to you for a second. Do you see parallels here with 2008? And from your hat and where you sit as the CIO, any advice or thoughts on risk management, given it seems like this can happen, and it is?
Yeah, I mean, there's slight parallels. It's not exactly, but you know, we over the last year and a half, when you've had this big DeFi craze, we've keep saying, if you don't know where the yield's coming from, you're the yield, and that is actually completely played out. It actually looks a lot more like some of the old lending platforms like LendingTree and some of the other ones. If a lot of people remember that back in 2012, what had happened back then was there was this big promise that there'd be peer-to-peer lending on these platforms, but it wasn't a two-sided market. There were people that wanted loans, but there weren't people that were giving them. So what these platforms did was, they raised a lot of venture capital money. They utilized their own balance sheet to take the other side of that debt, and then they would also get hedge funds on the back end to sort of manage the back end of it. I mean, this is really similar to what happened here. These big lending platforms like Celsius and BlockFi and Voyager were utilizing their own balance sheet to make loans. They were essentially managing a hedge fund on the back end to try to earn returns. The big hedge fund manager that was doing a lot of this for them blew up when the markets went down. So yeah, very similar to those peer-to-peer lending platforms right after the financial crisis. And even going back, if you look at repo and auction rate preferreds and CDO cubed products that were coming out and and really blew up between 2007 and 2009, those things happen. It's a lot of these are the same products over and over again. People just think that they've come up with something new. When you recognize it and when you know it, you see it, which is why we've avoided a lot of that.
Thanks, Stephen. And, just one note on this that's just been remarkable, especially for our team at Valkyrie, is just that a lot of these loans were completely non-collateralized. I mean, it's up to $700 million that was loaned out to Three Arrows Capital from Voyager and others with zero collateral to back. It's, quite remarkable, and Voyager obviously being a publicly traded company. But Josh, just one last question, and then we'll lead into the next slide. Any other explanations on Celsius unwinding here? Let's just pause on these very big contagion issues that's making all the headline news.
Yeah, so one thing we know as Celsius is trying to restructure their book, or whatever happens in the back end of bankruptcy wise, we can sort of see that on chain, and we can see these activities happening sort of real time, even as they're today moving thousands of BTC around potentially to get ready for an OTC transaction, or on the 12th yesterday when they moved 410,000 ETH on chain, likely for an OTC transaction as well. It looks like they are liquidating their book to get to cash, I assume here. It's hard to really say. But one thing, again, I'll just highlight, Curve, Aave, Compound on Ethereum, these protocols worked exactly how intended. They continue to work. There was no issues whatsoever. So the problems here really are not necessarily the code. It's what the people did with the collateral at the end of the day. And Anchor reached a $14 billion AUM peak between UST and Terra. I think that was between 50 and 60 billion AUM at its peak. So, these are very, very significant markets that kind of just blew up, right? So that's how we got in trouble on this side of things. But on the chase for yield for Celsius, it's good to know sort of what happened. Why are they touching what they're touching? And then that leads you to have to explain this liquid staking derivative staked ETH stuff. So ETH is transitioning from proof of work to proof of stake, likely sometime this year. And that's a protocol change. That means there will be no more mining on the chain. And ahead of that protocol shift, they enabled what's called the beacon chain. So you could send ETH to a staking contract and start accruing those staking rewards before the staking is actually live on the chain. And from that, there was this derivative called staked ETH created, where it sort of unlocked your capital to allow you to use it to kind of collect yield on yield. And you can kind of see where this is going, but it makes sense. Maybe you want to hedge your staked ETH, or you want to hedge your staked position, and maybe you want to provide collateral right in that lending DeFi ecosystem. But how it sort of played out, at least again based on the on-chain evidence, this is from Nansen, just showing you the amount of ETH that's been deposited in that contract since that was enabled. It's certainly very popular, and it's understandable. But the kind of the loop that happened was the lenders such as Celsius were sort of using ETH, putting it in that staked ETH contract for a yield. There's a timing component here. The yield doesn't get unlocked really until after that merge takes place. And then there was ways to move that staked ETH into bonded ETH on Terra, and then put it into Anchor. So this is how they attempted at least to collect yield on yield. And this seemingly works fine if everything's normally operational, right? But the problem is when we look at how exactly Celsius got in the most trouble, I think, was based on this staked ETH and ETH price. So again, around May 10th, May 9th, we saw the one-to-one seemingly peg. It wasn't really a peg. It was just kind of faith in being able to redeem. The pair price declined significantly, continues to hold below one-to-one price. And if you're trying to redeem this, you need liquidity on the other side, right? You need ETH willing to be traded for staked ETH. And if you have staked ETH and you're trading it for ETH, you're taking a 5% potentially loss on that. So Celsius both got caught in the illiquidity trap of this, as well as just not being able to redeem this one-to-one. This is sort of the open market price. What you're able to get on OTC side of things could be vastly different, but what we can see on chain looks like they, like I said, liquidated their staked ETH position, probably at some discount to the spot price. So this, again, not only are they losing money with Anchor, or lost money with Anchor potentially, lenders in general, but any lenders trying to double dip on their yields through this sort of ecosystem, also in trouble, not only price wise, but the duration mismatch was also a problem, right? Again, if you're having people redeem capital and you can't give it to them at this time because it's trapped in this forced selling mechanism that you don't want to take part in, right? It's just it's a giant mess, obviously. And I also want to talk about miners real quick, because miners, while not maybe largely implicated in all this, they are part of this broader credit, crypto credit or debit ecosystem, right? They certainly levered up over the past year to create these industrial size facilities. And when the credit dries up, the miners are then potentially forced to sell their treasuries if in Bitcoin, or forced to pay back loans maybe at the wrong time based on market conditions, right? They weren't necessarily expecting to get called on a loan so quickly. And they're also a part of this broad ecosystem. Now, we haven't yet seen hash rate decline super significantly. You know, we usually see in bear market periods, we usually see hash rate decline to a much greater degree than this. Another possible reason for some of these declines, at least intra-week, a lot of the miners are located in Texas, and if you're familiar with ERCOT and the grid in Texas, they have decided collectively, the industrial Bitcoin miners, that, you know, we're going to take our foot off the pedal when we're asked to, or when there's issues with the grid stability. And that's the biggest draw really for Bitcoin mining, is that they're able to provide this grid stability. They're able to mine, you know, off peak hours basically, and they can really flip that on and off at will. So it's not really like a massive ask for them to say, you know, we're going to power down here. But the mining facilities in general, you know, you might see headlines about them. They're also related in some ways to this, because they do touch the credit markets on the crypto side of things. But I haven't seen any massive concerns, at least publicly, for any of these miners as far as issues on that front.
Thanks, Josh. Yep, and continue on. This is very helpful.
Yeah, I'll just get to Tether and USDC real quick. So Tether, like I said, has this bogeyman baggage, and again, around early May, there were concerns that Tether didn't have what they said they have potentially in their reserves. This continues to be the case. You continue to see headlines about Tether shorts and whatnot, and that's fine. And I'm glad there's competitors to Tether like USDC. I'm glad that the market is saying, look, you better clean up your act even more than you already have, or we're going to continue to redeem Tether. And thus far, there hasn't been any issues reported anyway that Tether's had trouble redeeming. But you can see Tether's shed somewhere to the degree of 19 to 20 billion in circulating supply since the peak, whereas USDC has picked up some of that sort of flight to safety, kind of as Stephen alluded to earlier. There are better and less better stablecoins from that degree. And USDC certainly really kind of the gold standard when it comes to the visibility of their reserves. And we can also see that in these stablecoin prices. Again, around May 9th, when there was this massive blow up really with Terra and UST, when that started, there was just fear everywhere. And you can see USDC's price, for the most part, prior to that, had hovered below $1, Tether above $1, and that certainly flipped in a big way. I know on Binance, I think USDC went to $1.13 maybe again, like there's the peg is there, but it's really the market rate, right? If there's a demand at a specific time or more supply than demand, the prices on exchanges can really fluctuate pretty wildly in that period. But as we stand now, Tether is holding slightly below $1. I mean, we're talking 99997 or something, right? Not massively out of whack, but it is definitely different than what it had been previously. And USDC holding that slight premium. So to me, this is the market saying, again, like, we know that there are potentially some issues on Tether reserves side of things. You know, we've looked at it internally and looked at their commercial paper. It's sort of on the up and up. Looked at their treasuries, US treasuries, that sort of thing. It doesn't look like they're at massive risk, but they're just questions based on, you know, what they're able to tell us or what they do tell us versus what they have. They also, by the way, were a large investor in Celsius and had $1 billion loan with Celsius that was over collateralized, and they've since liquidated. But yeah, I think that was part of this as well. When we're talking about contagion, a lot of these players invest in opportunities. So when everything takes a hit, you know, it sort of makes sense that everybody's implicated in that. I guess moving on to technicals real quick. I wanted to talk about the drawdown in general. You know, for people not in digital assets, this might be like a breathtaking event. It certainly is. You know, we're down 72%-ish on Bitcoin's market cap from the highs. But when we look at the previous bear market periods, this isn't out of the question. If we look at 2011 or 2015, 2018, those drawdowns certainly got worse from here, which is kind of in line, I guess, with our expectations as far as the macro stuff is concerned. But none of this is really out of the question. Another metric that we look at is realized cap, which is the cost basis of all the coins that have moved on chain. So it's just the average cost basis of the coins. And we're also seeing prices draw down below that, similar to what we've seen in previous bear markets. So it's not too terribly out of the ordinary to see sort of what's happening here. And another way we can measure that, you see me talking about this a lot if you watch any of our content, but MVRV is a measure of market cap versus realized cap. And when we look at prior bear markets, we typically have this extended period, a year, 3 months, 6 months, where we hold the market cap below the realized price or the average cost basis of all the coins on chain. So this tells me we are at bottomy type levels based on prior historic values, but we probably need to spend some time here, some pain for a lot of people before we dip out of this. Just, you know, in a vacuum on an island, if I'm looking at this metric, that's what I'm waiting to see going forward here. And I wanted to talk about the 200-week moving average as well on the technical side of things, which historically has been a big important level since early Bitcoin's inception, but it started to print in like 2014. And the previous bear market lows have been, you know, they've bounced at those levels, let's just say, right? So it is slightly concerning that we're holding below that here now. And it looks like we're sort of treating that level as resistance. But again, if this held here for 3 months and bounced, it wouldn't be surprising to me. I think in a vacuum with macro notwithstanding, that's certainly what I'd be expecting. And we can also look at this in different ways with technicals, just sort of a line of best fit sort of situation. This is called a power law corridor. And I have on here the halving dates as well. And you can kind of see how we've appreciated over time and how we've held within these sort of predictable levels, I guess you could say. And again, where the bottom, where you'd expect the bottom to be, is sort of the next level down based on this potential trajectory. And we typically do best in between the halvings. And so the next halving isn't until 2024, right? Yeah. Could be early Q1, Q2, 2024. So, there's plenty of time to like position around this idea that we're in this 4-year cycle. This is an important part of the equation when we're trying to figure out, okay, everybody's bearish. Everyone loves to get bearish at the bottom. It's understandable, but to try to rein that in historically and look at that and how that looks.
Josh, to pause there for a second for
Sure.
Some folks on the call, can you just quickly explain what the halving is?
Sure, yeah. So as part of Bitcoin's code, programmatically, about every 4 years, the issuance decreases by half. So if we look at around 2013, around 2015, and between kind of post-COVID, funny how that lined up, but post-COVID lows, those are when those block reward halvings occurred. So the inflation declined or decreased effectively by half. So at this point in time, we're sitting around 1.8% inflation on Bitcoin per year, and that's going to continue to decline over time. So the next halving event would be early 2024.
Thank you.
Yeah. So certainly people, that's one of the draws of Bitcoin is that programmatic issuance reduction like that. Also just looking at sort of the almanac, Q2 has historically been one of the better quarters along with Q4, and that's certainly not been the case over the past couple of years. So it'll be interesting to see how this shifts, if it does shift, if these quarter alignments change, or if this just goes to uncorrelated, depending on TradFi markets. But the best case scenario for me in my head would be at least 3 months of sideways, basically zero out this bearishness, find a bull bear equilibrium, and then potentially do something in Q4, right? I don't want to prognosticate too much, but I think it's going to take at least 3 months for this to settle down on the market side of things, definitely. Also, if we look on chain, this is active addresses. This is a way of measuring on-chain activity since inception for Bitcoin, for Ethereum, for some of these other chains that I was able to pull the data. That on-chain activity continues and really hasn't declined to the degree it declined in the previous bear market. We continue to see robust on-chain activity on Bitcoin, on Ethereum. If we zoom in a little bit on BNB, which is Binance chain. So it's not like just because price is declining, everyone's just throwing up their hands and saying, we don't want to touch this anymore. There's still sustained activity throughout all of this, regardless of price, which is certainly healthy to see. Some of these newer chains, not so much. That's not really the case for a lot. Some of these smaller coins or newer chains, but certainly for the leaders in activity previously, like Bitcoin, like Ethereum, there's still plenty of robust on-chain activity there. Another thing, activity-wise, I'll mention is VC investments. This is just in the United States specifically. You can see there was a lot of VC investments in the first few months of the year. That certainly settled down a little bit, but we're still seeing infrastructure investments, physical infrastructure in Crusoe's case, which is gas flare mining with Bitcoin, chain analysis, OTC, exchanges, Circle, obviously, consensus, a big part of the ETH ecosystem. So we're still seeing those raises happen, just maybe not to the flurry and flourish that they were happening in the first couple months of the year. But again, we're not seeing everything just sort of go to zero. We're seeing sustained activity, maybe better projects are being funded now, more discretion, stuff like that. But we're still seeing plenty of investments in crypto broadly.
Thank you so much, Josh. Oh, sorry. Did I cut you off?
No. That was it. So hopefully that wasn't too long-winded. But the TLDW or TLDR is you definitely have to keep your wits about you when it comes to risk management. Not your keys, not your coins. You have to know where the risks are: counterparty risks, security risks, protocol risks, that sort of thing. A lot of people are looking forward to the Ethereum merge over the next potentially 6 months, let's say. It's hit the successive test nets it needs to get closer and closer to come to the live mainnet. So that's going to be a big event, I think, for people, because Ethereum's issuance at that point will actually drop below 1% or even negative for the time being. So that's a big fundamental shift in sort of what's happening currently for Ethereum. And obviously bear market lows, everyone's sort of asking, when that's going to come about.
Thank you so much, Josh. That was very full of information and I really appreciate it. I'm also looking at the chat if there's any QAs. If not, Stephen, I'm going to ask you one last question and possibly give everybody 8 minutes of their day. I know that we did speak about Tether, thank you, Josh, which is definitely something we watch very closely at Valkyrie with our risk monitoring tools. As Josh threw out some Bitcoin adages, I'll throw out another. Don't trust, verify. We don't trust, we verify. Otherwise, we don't invest. So, Stephen, to conclude here, given all the uncertainty that we've especially gone into today, how do we control risk from a process perspective? And also, what are we going to look for in a recovery?
Looks like we lost Stephen on the call.
We lose Stephen on the call.
Yeah.
All right. Well, then maybe we'll get Stephen back another day. So maybe we close out here, unless Josh, you have any ideas on that?
There was a question about USDC's AML KYC requirements.
Sure. Do you, yeah, just reading it off really quickly. Sorry to cut you off. How does Circle USDC manage AML KYC requirements is the question.
Sure. Yeah. So if you are an individual or entity who wants to mint USDC or get involved with that, you can go to these companies and you get onboarded, you get KYC'd, you get AML, whatever. And, you decide I want 10,000, 10 million, whatever it is. And then they will take your capital and mint the equivalent after fees, USDC. And then that sits on chain or in a wallet, right? However you want to handle that. It can go forth and multiply, it can do whatever you want it to do in the DeFi ecosystem. But once it's out there, Tether is the same thing. There's sort of no, once it's in crypto, it's in crypto. They're in a digital asset environment. There's no specific KYC AML checks going on in that point in time. There are continued discussions about permissioned pools of money in DeFi. Maple Finance is one that's using that concept. But I think we're going to see more of that with probably regulations that are coming surrounding stablecoin reserves and what you can do with as a crypto lender. I think we're going to start to see more of that permissioned pool type of activity.
That makes sense. And Josh, maybe just one last question here. How do we go about our watch list monitor process? What are we looking for at Valkyrie?
Yeah, so I'm always looking for, I always look at on-chain activity. Sometimes there's a divergence or a mismatch between price and on-chain activity. For instance, I like to see something, at least have a pulse in order to figure out, are people using this for its intended purpose, or are they just here to, buy low, sell high? That's a big part of it. Obviously, knowing if there's an algorithmic stablecoin attached to a chain or in the ecosystem is important to know. I discussed a lot of the on-chain monitoring that we do just broadly to see, what is Celsius doing with their money? That's one of the beauties of blockchain. We can see all that happening real time, and you can get alerted to that. You can get notifications for all that activity. Also looking at degrees of decentralization as far as where coins sit, where the nodes of the network are, how many of the nodes are there, how big is the network. A lot of less sexy things that people don't care as much about, but from a decentralization standpoint is extremely important. I'll just point out to BNB, Binance chain. Their chain is certainly more centralized than a lot of the other chains in the ecosystem. Even Solana as well is quite centralized when you compare it to everything else. So you sort of have to mitigate that with expectations of just because something is more centralized doesn't necessarily mean that it won't do well or can't do well. You just have to know that and set expectations accordingly.
Thank you so much, Josh. All right, I think that we're going to end it here with 3 minutes to go. Everybody, thank you so much for joining us today. Again, this is Josh Olzsewicz. I hope I pronounced that correctly. He's our head of research, but also quite a storied career of trading and portfolio management and research in crypto almost since the inception. So quite an expert here. We had on Stephen McClurg, who unfortunately had to run due to an emergency, but he is my co-founder here at Valkyrie and also our CIO. Just to wrap up, for anyone that may have jumped on this link due to a LinkedIn message or otherwise, Valkyrie is a digital asset management firm. We have a series of cryptocurrency trusts, ETFs, SMA strategies, and a DeFi hedge fund with a couple other funds launching soon. So please be on the lookout. If you need credit for this course, please reach out afterwards and we can help you with that. And again, thank you so much for listening.